Hi, my name is Ryan Kimmel from Double Lion's macro asset allocation team. Recently, our group published a report titled Finding a Bottom in Equities. And in this note, we take a look at the current drawdown in equities and put it in context to historical bear markets that have occurred during the post-war period. We also identify a couple variables like valuation and severity of recession that help determine the magnitude of equity drawdowns seen during recessionary episodes. We then take these findings to help us project how far equities may fall if the US succumbs to a recession over the coming months. Now, some of the analysis in the report is on the technical side, so we thought it'd be helpful to provide you with a short slide presentation that covers the analysis and gives you the highlights of the findings in the report. So with that, let's get started. So I'm sure as many of you are aware, it's been a very challenging year for equity investors. The S&P 500 is down over 20% in the first half of the year, and that is the worst first half performance for the S&P 500 going back over 50 years, back to as far back as 1970. Now, the weakness in equities has been broad-based. Many major equity indices are in bear market territory. In fact, the NASDAQ, the Russell 2000, and the Russell 1000 Growth Index are in deep bear market territory, down over 30% from their all-time high. Now, the recent correction, one notable attribute of this current drawdown is that it's been entirely driven by multiple contraction. You can see on the blue line on this chart, which shows the forward PE multiple for the S&P 500, that has declined from above 22 times at the end of last year, all the way down to around 17 times currently. And that has coincided with a surge in real yields, which is inverted on this chart and is the beige shaded area. And they've essentially been moving in lockstep together this year. And that is on the premise that equities have responded poorly to global central bank tightening as they've essentially been caught behind the curve in fighting inflation and have had to essentially tighten very aggressively and indicated that they were going to continue to tighten monetary policy over the coming quarters. Now, just to put the current drawdown in equities in context to historical bear markets seen since in the post-war period. So the current drawdown from the January high is around 23.5%. This would be the 10th largest correction for the S&P 500 over the time period. One thing I'd note is that bear markets that occur during recessionary periods tend to be larger, with a median drawdown of around 35%. That's compared to bear markets that are experienced during non-recessionary periods, which have a median drawdown of around 28%. So how do equities perform after reaching this 20% correction threshold, or quote unquote bear market territory? So on this chart here, this shows the forward performance on a 6-month, 12-month, and 18-month horizon after breaching that 20% threshold. And I break the episodes into recessionary bear markets and non-recessionary bear markets. I'll focus on the non-recessionary bear markets first, which is the table on the right. And you can see that generally equities perform pretty well after reaching that 20% correction threshold with a median performance of around 20% on a 12-month horizon and a pretty high hit rate of around 75%. So that means around 75% of the time, the equities have produced a positive return. However, during recessionary periods, investors are actually better off waiting 6 months or so because, as you can see on this chart here, equities, the median return for equities on a 6-month period after reaching that 20% correction is down 4.5% with a rather low hit rate, where equities are positive only 37.5% of the time. And this also essentially shows the large drawdowns that you see during more severe recessionary periods like in 2008 and in 1973. And unfortunately, the probability of recession has increased over the last 6 months. This chart here shows the probability of recession based on a survey of economists by Bloomberg. That's increased all the way up to 33%. But there are other real-time measures based on financial indicators like the spread between the 10-year and the 2-year Treasury, which are indicating a higher probability. According to the 2s, 10s, as we like to call it, that's implying around a 45% probability of recession over the next 12 months. So recession is definitely becoming top of mind for investors recently. Now, how do equities perform, or what size of drawdown do they typically experience during recessionary episodes? And this chart here shows the drawdowns for the S&P 500 over the 12 recessions in the post-war period. And you can see the median drawdown for the S&P 500 was around 24%, but there's a lot of dispersion with the average drawdown around 30%. And we've seen drawdowns as small as 14% in 1960 to as large as 57% during the global financial crisis. That really begs the question, are there any variables that can help determine the magnitude of drawdowns seen during recessions? And the first variable that we took a look at was peak valuations heading into recession and whether that has an impact on the magnitude of drawdowns of equities during recession. And what you can see on this chart here, we're using the cyclically adjusted price to earnings ratio that was developed by Dr. Robert Shiller. And the drawdown of recession is on the y-axis. And you can see a pretty clear relationship. The higher the equity valuation is heading into the recession, it tends to coincide with larger equity drawdowns once we reach a recession. And that is particularly relevant during this cycle. As you can see on this chart here, the cyclically adjusted price to earnings ratio back in the fourth quarter of last year reached the highest level at over 38 times seen since the dot-com bubble in 2000 and 2001. So perhaps that could indicate, if we do end up falling into recession, that equities may fall further than typically experienced during recession. Next, we took a look at drawdowns and the severity of recessions. And on this chart here, this shows the drawdowns during recessions and the duration of recession, or the length of recession in months. And you can see that typically long recessions, severe recessions, tend to coincide with larger drawdowns in equities. We took a look at some other metrics like the change in the unemployment rate and the decline in real private fixed investment. And the same theme here as well, where the more severe the recession, it tends to coincide with larger drawdowns in equities. So putting these two factors together, we can develop a model based on peak valuations and severity of recessions, where we're using the duration of recessions to project, how far equities may decline from their highs if we have a severe recession scenario or a mild recession scenario. And the output is basically on this chart here, which shows those different scenarios on top of the S&P 500 price level. And you can see that during a mild recession scenario, we could see equities decline, or the model implies that equities could decline down to 2671, or about 30% below the current level. And under a severe recession scenario, we could see equities decline down to 2046, or around 47% below the current levels. And then under the non-recessionary scenario, we could see equities climb around 18%, around 45.18, and this is based on that forward return analysis that I presented earlier in the presentation. And now that we've developed our scenarios, we can then project an expected return for equities. And on this chart here, we basically project or come up with an expected return based on two different recession probabilities, one implied by the 2s-10s curve, as I showed earlier, and the other implied by the Bloomberg Economist Survey. And I will note that the severe recession scenario, we're projecting at 10%. We believe that the probability of a severe recession is actually quite low for this cycle, given the health of the household and corporate balance sheets, and the banking system is relatively well capitalized, which should mitigate the severity of recession. So using the 2s-10s implied probability of recession, which is around 45%, that gives you a projected return of around -5%. And then using the Bloomberg's probability of recession, which is around 33%, you get an expected return of around 0%. So not very compelling from a expected return analysis, at least using this framework. We would likely need to see either recession probabilities come down or lower overall levels in equities for the risk return profile to look a bit more attractive. Now, from a tactical perspective, we would like to see capitulation in equities, or we'd like to see peak fear. And that is indicated here by the volatility index, or the VIX, which is essentially the price investors are willing to pay for insurance on equities. And you can see that the VIX tends to have these short-term spikes of around like the 40 level, but it doesn't last very long. And in that 40 level on the VIX tends to be a pretty good tactical level to add equities. As you can see on this chart here, the VIX has crossed 40 around 9 times since the early 1990s. And 8 of the 9 times you've had positive performance on a 6-month forward basis. The only negative performance was during the peak of the global financial crisis in 2008. And I'd also note that you've even gotten backed out positive returns during multi-year bear markets, like in 2001, with a 12% 6-month performance during that period based on this signal. So just to summarize, even though equities are down 20% from their highs, the risk return profile does not look that attractive, given that if the US does fall into a recession, equities could fall quite a bit further based on valuations that we saw during this cycle. We'd likely need to see 3 things happen for us to get more constructive on equities. 1, we need to see the probability of recession decline. 2, lower equity levels. And 3, signs of capitulation in the markets, or signs of peak fear that could coincide with the volatility index, or the VIX, above that 40 level. So with that, this ends the formal presentation. I hope this was helpful. You can find links to the original report on our website at www.doubleline.com, or on our Twitter page at DLineCap, also on our LinkedIn page. With that, I'd like to wish you good luck in the second half of the year. Thank you.